Hi, this is Joe. I'm going to give an update on the S&P 500 index, and then I'm going to go into the Qs. I'm actually going to look at a specific trade in the QQQ. I thought it was pretty relevant, especially based on some of the questions I've been getting from a few of the viewers. I want to go straight into the charts, and because I want to make sure I can cover all this and not get this video too long. Before I get going, though, make sure you hit that subscribe button. And also let's pound the like button as well to help me with the YouTube algorithm. I would appreciate it. All right. So first of all, we'll start with obviously the 4 time frames sitting here. I mentioned the last time how we'd made a huge move from the bear market low all the way up on this monthly chart for 5-6 months, and how the sentiment had shifted. And one thing I'll just mention very quickly is that even though we've had some harsh price action over the last week, the sentiment numbers did not change very much. The number of bulls didn't really change. It was a very marginal shift. So that would tell me there's probably a little bit more risk in the market based on the sentiment numbers. Let's go ahead and get straight into the individual time frame. So, I mean, if I look at the monthly chart, as I mentioned, there is some risk in it. When I show you when we get into the QQQ chart, I'm going to show how much more I think pullback risk there is based on the bigger picture. But we've got a pattern that is in an uptrend. But again, it made a new high, made a new marginal high. Sentiment got a little iffy, and I think it wants to fill in some more. And if we go and look at the weekly, again, it gets a little bit more pronounced. And so what ends up happening is when you start to break the trends on the shorter term time frames like the hourly and the daily, as I've mentioned in the past, our target is going to be the weekly 18 is going to be kind of like our first target area. So it's around 3,200. That happens to coincide with price support. If I go and just show you here, 3,200 is right where this price area is. It was a price area on the way up, and it's a price area coming back down. So I think that's a pretty logical spot. Now, the market doesn't always trade logically. It might overrun it somewhat. If it does, we have the 40-week moving average there just right around 3,100. And then obviously the 18-month line is right around 3,000. I want to look at the daily chart. And, what we talked about the last time is the violation of a minor violation of the trend line. And then was it, or a test of the trend line, I should say, and then it was going to try and rally up. And we're going to see what kind of reaction we got back to the upside. Obviously, the MACD lines did turn down, but I wanted to focus in on the same chart related to the 18-day, 18-week, and 18-month line, and then the volatility measure. So we talked about the sentiment numbers. The sentiment numbers aren't great. And if we go and look at the volatility, we're getting very, very close to turning this to a negative. In fact, I believe today that the moving average line is now rising, and the ATR is also above it. And so that would, to me, that would push this part of the market conditions to a negative. So now we've moved the sentiment numbers to negative, and now we've got this at a negative. So there's obviously some risk in place overall for the market. And I think it's important to mark these things down. Again, have your own way of calculating these things if you want, but make sure you have some sort of weighting for each one of them so you know kind of where the market is in relation to how you feel overall. If you look at all these things this way, I think it'll give you a much better sense of how much risk there is. So notice what's taken place if we just look at the 18 on the daily chart. It has started to turn down. It looks like we're heading back. It looks like it wants to come down and at least test this 18-week line. And as I say, when you break and you truly break the 18-day, your target should be the 18-week. That happens to coincide with the price action. Let me quickly go to the hourly because I do want to spend some time on the QQQ. So if we look at what's taken place, the last time I mentioned it had dropped down and I was looking for it. It was actually from this spot here. I said, maybe we can rally up and head down. And instead, what's taken place is we moved lower first, So this dropped, and then we got the rally to the upside here. So it really did the same thing I was looking for. It just took a little longer to get going, because this first rally here was really the first spot. This was the first entry spot if I'm looking to get short. So the problem is, you come in the next morning. Now, you could have put this on up here, but you really didn't have a trigger yet. But if you could have shorted into this rally saying, you know what, I just think there's some downside risk here, especially if you're hedging your longs. I don't think that's a bad idea at all, not to wait for a trigger. If you're trading to make a profit in a short trade in the spider, then personally, I would wait for a trigger. And if you notice, what happened is it gapped down. It didn't really give you an entry point. And so, you know, I'm not interested in putting a trade on if they gap it down like this and there's just no real entry point. I'm really not interested in putting it on. But if you notice what happened, it rallied up and it came inside the zone between the 18 and the 40, and these lines are still pretty negative. And if you notice, we actually had, kind of interesting, because this doesn't happen all that often. I don't bring it up too much, but this was a reverse divergence. This is out of my book, a lower high in price and a higher high in MACD. So it's reverse divergence. Normally you're looking for the opposite. But in this case, it actually does give you a pretty good signal. And the other thing that I noticed is that while it was doing that on a MACD basis, the ADX was actually holding 25 based on the selling. And so that's pretty bearish. So all of these were sort of indications that there was some weakness here. Let's go straight to the Qs, because I want to actually show you how I would take advantage of it. First of all, I do want to look at the monthly chart, and let's just focus in. So again, if we go and look at all 4 time frames, look at how much more extended the price was from its 18-month line on the QQQ. So to me, there's a lot more pullback risk in the Qs. I think if I want to play for a downside move, I think it makes more sense to me, if we look at the weekly, look at this long uninterrupted move, I think it just makes more sense to play for a move back down to the 18-week, or even where, if you look at price support, legitimate price support is much, much lower on the QQQ. So it's possible we're going to come inside this range between the 18 and the 40 on the weekly. So if I start to look at this, and then again, let's just take another, let's look at this same way. Look at what's happened to the volatility. Look at how huge a move the volatility has made in such a short period of time. This is only about 4 or 5 days worth of trading, and we've clearly got the moving average rising. I mean, any type of a retracement here would also be a pretty negative sign in terms of what the market's heading to do. But it looks like what the market wants to do is go ahead and work its way straight down to the next target area. So let's get into the trade. And what I want to do is, I don't typically look at the 10-minute on these videos, but I thought this was such a great example. What I want to do is I want to focus in on the 2 left charts. Let me zoom in a little bit here and zoom in a little bit here. So this is now, this bottom left chart is a 10-minute chart. I just switched it. And if you notice what happened, we had the same pattern where on the hourly chart we came down, we rallied up, but instead of giving you an entry through a trigger, it gapped down. And there just really wasn't a play there. You don't want to be shorting gap downs. And, you know, maybe if you got a little interim rally and you wanted to go down to a 2-minute chart or some really tiny time frame and try and play it, I guess you could do that. I would prefer to wait for the next signal. And so what happened is, again, we came into the zone. Now, we've been talking about this same pattern on the weekly and the monthly, weekly, daily for a long time. I've done several videos. If you go back, it's called the Easy Multiple Time Frame, Easy MA, Moving Average strategy. And if you've got an 18 and a 40 and you come into that zone, they're both basically declining. And again, in this situation, you have very strong indications based on both the MACD and the ADX that there is continued downside risk. So once I see that and I'm in the zone, I'm going to go down to this time frame. So if we come to here and we start looking at a 10-minute chart, Let's zero in on the 10. In fact, I'm going to go ahead and go straight down to the 10 minutes. So if we look at the 10 minute now, I can go through, I could literally draw in my trend line. If I want to draw on a trend line and see that the 1, 2, 3 change in trend took place. And again, this was right in the zone. This line is showing basically where we were in the zone on the hourly, and it was time to start going down to a lower time frame to get entry. And so there were a couple of things. There's a couple signals from my book, a pinch play I talk about a number of times. In fact, there's a trading strategy in the back of the book that uses the pinch play as its as part of the plan. And if what happened here is, yes, the break of the trend line and the break of the 40 is definitely a trigger to the downside. You could have gotten short this on this move right here. But I think a better strategy when you look at what's taken place, look at how far away you would have had to put the stop. So if I trigger up there, I got to put a stop way up here. It's not as good a risk reward, especially on an intraday time frame. You don't like to be shorting after 2 big bars to the downside. So you want to wait for a short-term rally. And, you know, if we look at what actually took place, you had 1 higher low, 2 higher lows, 3 higher lows, 4 higher lows, and look at how small the top bar was. So you could have shorted this based on that signal. Again, this is part of the pinch play. So it would have shorted right below that green bar, and the stop would go right above the green bar. And you maybe give it a little bit of room above. So that was actually a nice trade. 1, 2, 3, 4, 5 bars down, and then you got kind of a big bar. You could have traded out of a partial position, taken some profits, or you could have taken the whole thing. I mean, that was a pretty good signal there. The pinch play is signified by MACD coming down underneath and then pinching back below, back underneath the signal line, but not crossing it. And so this was one pinch right here, and then we actually had a second pinch play. And look at how beautiful this setup was. 1 green bar, 2 green bars, 3, 4, and that was a higher low, higher low, higher low, 4 higher lows, small rally based on momentum, no big bars, very, very orderly. And then again, you could have shorted this, breaking the low of this bar here and stopping it out above. So if you look at how much you're risking there, you know, you could play this. Let's zoom in a little bit, zoom out a little bit so we can see what the targets were. Because this is one of the things I wanted to talk about. So if we have a target, which I would say would be filling this gap down here, which it ended up doing. That was actually where it ended up finishing the down move for the day. Based on the way this declined, after we've dropped this much, I would be looking at a big bar down like this as an opportunity to be selling. I wouldn't necessarily be holding out for this last little bit here. Now, you ended up getting it in this case, but if you get a number of red bars to the downside and then you get a big expansion bar to the downside, you want to be looking to do some covering, even if it's partial, but definitely a pretty good. I would probably be taking at least half off on this trade. Huge, huge move relative to how much you risk. So I just thought this was a great example of, again, the same patterns we're trying to find on the longer term time frame. Well, this is a short version on an intraday basis, and it shows you how these patterns repeat. It also shows you how you can take advantage of using MACD and ADX in your favor on when you're getting a rally on the higher time frame. So hope this was helpful, and we'll talk to you soon.